Hello everyone, our group will give you presentation on financial analyzing today. In this presentation, we mainly choose company 1 and company 2 to make concern comparison. We compare the performance of two companies by calculate the financial ratio of the two companies in terms of profitability, liquidity, asset structure. Next, Junwen and I will present the first part. Next, in terms of probability, next, please. Next page. In terms of profitability, the operating the operating profitability rate of Company 1 increased steadily from 2017 to 2019 and reached the highest value in 2019, which was about 0.046, while Company 2 was also growing steadily in this respect, with the operating profit rate of 0.035 in 2019. Secondly, the performance of Company 1 and Company 2 in ROA is similar. While the ROE of Company 2 is higher than that of Company 1, that means the level of ROE performance was better in Company 2. From this data, it can be said that the operating profitability of Company 1 is better than the Company 2, but the return on equity of Company 2 is better than Company 1. That indicates that Company 1 may earn more money while Company 2 can gain more return per equity share. In terms of in asset efficiency, the value change rate of Company 2 in assets turnover rate will be greater, which indicates that Company 2 is consistently improving the assets utilization efficiency, and the weight is larger than that of Company 1. That's it.
Okay, next page. Yeah. Let's look at difference between two companies in terms of liquidity. The both of the current ratio and quickly ratio of Company 1 show a downward trend from the 2017 and 2019. On the contrary, the current ratio and quickly ratio of Company 2 are on the rising trend, and in 3 years, the current ratio of Company 2 is far greater than that of Company 1. This shows that Company 2 may be much better than Company 1 in terms of solvency, and Company 2 has a stronger liquidity. Finally, next page. Finally, from the perspective of the company's capital structure, the debt ratio of the Company 1 is basically tapped at about 0.55, while the Company 2 is basically shows a downward trend from the 2017 to 2019, and it is less than 0.6 in 2019, which indicates the Company 2 may have made a large number of loans in early stage, but during the period from the 2017 to 2019, the enterprise is constantly trying to improve its data repayment ability, so its debt ratio is declining year by year. In equity to liability ratio, the value of Company 1 is higher than that of Company 2, which indicates the proportion of owner's equity of Company 1 will be more, and that of Company 2 will be more. From this data, we suppose that if you are a risk-avoided investor, Company 1 will better as its financial performance develops steadily. Yeah, next page. Thank you.
Hi. So I will talk about the share price vs retail conclusion. So there are many different factors investors may consider when it comes to buying stocks or rebalancing their portfolios. One of those is a company's stock price and how the performance change over a certain period of the time. So comparing historical stock price to those of the present day doesn't actually reflect performance. So that's a reason we introduce retail system, uh, retail analysis can mark how a company is performing over time while comparing a company to their within the same industry or sector. Retail analysis comparing lines is data for a company financial system to revel establish reduce profitability. Next page. So next profitability. So return on equity. So return on equity is a measure of financial performance calculated by dividing net income by shareholder equity. Return on equity equal to average shareholder equity or net income. ROE is considered a measure of how effectively management is using a company asset to create profits. Next one. So it's also profitability. ROA, return on asset, is showing a percentage, and the higher the number, this more effect a company's management is managing in balance sheet to generate profit. The net profit margin is a ratio of the net profits to revenues of a company of the business statement expressed as a percentage. The net profit measure shows how much of each dollar collected by a company as revenues translated to profit. Next one. So as next one is profitability comparison. Company 2 has better performance on both ROE and ROA. Meanwhile, Company 2 has relatively stable performance on net profit margin ratio. So by consist of performance of Company 1 on the net profit margin ratio shows a huge increase, but consider all those ratios, companies too had better profitabilities. So next one.
So, hi, I want to describe the asset efficiency. So, the first important point in asset efficiency is the asset turnover ratios, which is measure the values of the company's sales or the revenues relative to the values of its assets. The asset turnover ratio can be used indicators of the effective with which a company is using to asset generate revenues. Another point is the no current asset turnover ratios, which is determining the efficiency with which a business uses its no current assets to generate the revenue for the business. So next we will be compare about the asset efficiency comparison. We compare about the asset efficiency, the higher the asset turnover ratio and the higher the efficiency of the asset generation comparing the two companies. The company 1 is 0.16 less than the company 2. The time inventory, company 2 is 3.74 less than the company 1. This means the company 2 sales will be weaker than the company's 1. The next we compare day inventories. The company 1 own low day ratios reflect the company 2 better management efficiency in selling stock or carrying insufficient levels of inventories. Next page, please. Next page. Yeah, so then we talk about the liquidities. So it's got two important points in the liquidity, which is the current ratio and the quick asset ratios. The current ratios compares of the all company's current asset to its current liabilities. These ratios measure a company's ability to pay short-term obligations or those due with 1 year. And another point is the quick asset ratios. The quick asset ratios indicates a company's capacity to pay its current liability without needing selling its inventory or get additional financing. So next page, please. And then we compare the liquidity. The liquidity ratio is a financial ratio that indicates whether a company's current asset will be sufficient to meet the company obligations when they become due. Compare both of the two companies. The company 1's ratio is lower than the company 2, which means when the company 1's ratio low indicates that the company's ability to repay debt in captivity situation is worse than of company 2. Moreover, company 1 has liquidity than company 2. Okay, next please. Next will be Gao.
Yeah, to equity ratio is calculated by dividing a company's total liability by the shareholder equity. It is a measure of the degree to which company is financing its operations through debt diversity holding on funds. More specifically, it reflects an ability to shareholder to cover all of the standing in the event of the business standards. Equity ratio indicating how much of a company assets to have been governed by issues equation share richer than by taking on debt. The lower the result, with the more backseat to company has used to pay for the asset. From table above, we can see the company 2 has better performance on debt to equity ratios, which means is that have relatively better capital structure. While company 1 showed better equity ratios, as the lower the ratios result, the more debt company had used to pay for the assets. This means company 1 have the more free structure on capital. However, we should also know that these two companies in the different industries, which means divided its structure. From this table, we can see the company 2, no matter from the table, we can see the company 2, no matter from the profitability, as the efficiency, liquidity, and the company structure is better than the company 1. So we believe the company 2 is better option to interverse. So that is our presentation. Thank you for your listening.
All right.